So this idea of a slowdown of some magnitude, obviously that's kind of got us the fourth quarter decline in markets in large part and is carried over into this year, even as markets have bounced. So what do you think the overall growth picture is, and I guess what's priced into markets right now?
So the growth picture, Mike, has considerably slowed. So we're not talking about like we were coming into 2018, coordinated global growth and EM online. What we're talking about now, though, is two gigantic pieces of new information. Probably fully priced in, right? The one is the Fed magically waking up in January and saying, you know, we're at our neutral rate. We don't need to go any more in 2019, or at least the first half of 2019. And you know what? We may stop reducing our balance sheet towards the end of 2019. They weren't saying any of that in December. So that's one piece. And then the second piece is unequivocally, it seems like the trade negotiations are going well. So that's the popular narrative. However, what it means to us is really easy financial conditions that we hadn't seen. So what do I mean by that? I mean that if you get an environment where rates stay around here and the dollar behaves, equity prices certainly, as we've seen over the past decade, have had a nice tailwind from easier financial conditions, and that's something that is certainly priced in, but something that will continue to be a tailwind for the market.
But easier financial conditions are around because the Fed's doing this, but there's a reason, right? The global slowdown. So how do you kind of...
And that's the tricky part, right? So if the Fed, if the narrative starts to evolve, that data is slowing, and that's why the Fed is not moving rates anymore, that would be a negative, right? That's a tail risk. That is something that we're certainly not forecasting for 2019. The forecast for 2019 is more around trend, Becky, than some of the real sinister stuff that was evolving around late last year around the global recession risk. That is, we would just disagree with that prior speaker. This year is more around trend. But at 2,800 on the S&P, we're going to need to see earnings be a little bit better than forecasted to get much higher than here to make new highs.
Given those conditions you mentioned, slower global growth and the Fed pivot, how does that change your positioning in domestic U.S.?
In domestic U.S., the Fed story is an important one, Wilfred. So we have increased U.S. equity this year by 10%, right? So that increase in that story is certainly driven by the fact that, yes, we were in full agreement that the growth story is not as good as it was last year. I mean, second quarter last year was over 4%, third quarter last year was over 3%. We're looking at 2-ish% growth this year. However, the Fed story, right, not tightening into a slower growth story is important enough for us to remove the defense that we had in the portfolio last year and add a little bit more to the offense.
Slower growth with a patient Fed obviously is a pretty good combination for stocks, as long as it doesn't turn into slower growth continuing to recede toward flat and the Fed basically having already gone too far, or the Fed having to move in an unexpected way. So where are we with regard to this kind of end of cycle talk that we were captivated with last year?
Yeah, so it's later cycle. We've gone from late to later cycle, right? So the end of cycle talk for us is certainly not 2019, and it's hard to imagine. Shocker, we have an election in 2020. It's hard to imagine growth slowing so much into recession before an election. I can't see that, right, at this point in time. And there isn't the bull market behavior that we saw in other cycles, like in the dot-com bubble, like in '08. All of this growth is real, Mike, right? It's not cash for clunker growth, right? This is real growth that is not based on gimmicks that can continue. It doesn't mean that we're going to have gangbuster growth, but slow and steady growth is okay. But I want to reiterate, in order to get the S&P up through 3,000, right, those kind of new highs, we need to see better growth and better earnings. You know, the Fed story and the trade story has been priced in, but financial conditions has tended to be a nice tailwind for the market.